Well, fear once again has taken hold of global markets in the last 24 hours. Bond yields for the US, Germany and even Australia are near record lows as investors flee to quality. But Spain's bond yields have hit their highest level since joining the eurozone amid fears its banking system is on the verge of collapse. Neil Woolridge reports.
Spanish miners are taking to the streets in protest against government funding cuts. But a bigger worry for the Spanish economy is its bond market, which is suffering a blockade of its own. Overnight, the interest rate on Spanish bonds hit 6.6%, the highest yield since Spain joined the eurozone.
Basically, I think what the markets are saying is, Europe, please get the policy in action and start being proactive.
Investors are worried about the health of Spain's financial system after the government this week pumped in $24 billion to prop up the nation's biggest bank.
They're carrying a lot of non-performing loans from the bursting of the property bubble over there. And we know that the Spanish economy is in recession, and we know that the unemployment rate is rising.
And that's making a difficult situation even worse.
The question is, we're not sure, or markets aren't sure, how much capital is needed, where it's going to come from and how expensive it's going to be.
That means markets will remain skittish until there's a definitive solution to Europe's problems.
Fiscal union, monetary union and an independent banking regulator, therefore to limit credit crunches in future decades. And that's effectively what they're asking the Europeans to sort out.
But at the moment, there's no clear or consistent message from European leaders about the way forward. The people of Greece will need to sort out their own political deadlock in 3 weeks. UBS's George Babouris says Greece must remain in the euro. While that would involve a costly restructure of Greece's debt, he argues it would be much better than the alternative.
Depending who dominates the polls, will be dominating the sentiment. And that's going to happen until the 17th of June. So that's not going to go away. So investors will remain challenged and fatigued, and everyone's going to be overreacting on certain remarks and quotes.
The Australian dollar is also in the crosshairs. It's lost more than 11 cents against the US dollar in 3 months, including another fall of more than 1 cent overnight to dip below 97 US cents. But Perennial's fixed income strategist Frank Eulenbrook says at other times when markets have been this fragile and risk averse, the Australian dollar has plunged much further.
The fact that it hasn't fallen a lot suggests that there's something else going on, and I think some of that is foreign interest in Australian government bond yields, because it's a AAA asset and it's one of the few in the world.
And that flight to quality has helped push the Australian bond yield below 3%. Local bond yields are now, like those for Germany, the UK and US, near historic lows.
And as long as markets are very uncertain and they become risk averse, any AAA government bond yield is going to find a lot of safe haven flows, and that will depress the yield well below what you'd expect just looking at fundamentals.
Good news for the government perhaps, but a sign that Europe's problems remain a long way from resolved.